For the past 2 decades, the locus of global credit creation has migrated away from traditional commercial banks. The institutions that hold consumer deposits no longer dictate the movement of the world's capital. That power has shifted to a sprawling network of hedge funds, pension funds, and private lenders, known as the shadow banking system. This migration has reached a milestone. As of late 2024, non-bank financial intermediaries control $256.8 trillion, 51% of all global financial assets, and the trajectory continues. The shadow sector is expanding 9.4% year-on-year, exactly double the traditional bank's growth rate. Global economic growth is no longer funded primarily by the regulated institutions the public understands, but by an unseen periphery operating outside the conventional perimeter of banking oversight. This environment was an accidental byproduct of post-2008 safety reforms. As frameworks like Basel III and Dodd-Frank forced traditional banks to hold more capital and shed risky loans, credit intermediation sought the path of least regulatory resistance, flowing into the unregulated shadow market. The Financial Stability Board monitors a specific high-risk slice of this market, called the narrow measure, entities that engage in bank-like activities without bank-like protections. This segment alone now accounts for $76.3 trillion in assets. Now, a deregulation paradox is emerging in 2026. Traditional banks, seeking to reclaim market share from shadow lenders, are successfully lobbying to lower their own capital requirements, including a 1% cut in the UK, erasing the very safeguards installed after the last crisis. Regulatory frameworks did not eliminate the risks revealed in 2008. They forced those risks to evolve and relocate into a system that operates without central bank backstops or deposit insurance. Shadow banks generate vast amounts of credit without a single customer deposit. They do this through the repurchase agreement, or repo market, a system of collateralized short-term loans that serves as the plumbing of global finance. In a repo trade, you provide $100 million in treasury bonds as collateral. With a 2% haircut, you receive $98 million. Reinvesting this repeatedly builds leverage exceeding 50 to 1. But if volatility spikes the haircut to 50%, margin calls force an immediate fire sale. Because this system relies on market confidence rather than central bank reserves, shadow banks act as shock amplifiers. During a crisis, they must pull liquidity from the market at the exact moment it is scarcest. This volatility is particularly hidden in the private credit market. Here, non-bank funds lend directly to corporations, bypassing traditional bank syndication for customized, much faster financing. This strategy has grown from a niche corner of finance into a $1.34 trillion market in the U.S. alone, with projections suggesting it will reach $5 trillion globally by 2029. To boost returns, these funds are increasingly using net asset value, or NAV loans. These are facilities secured by the fund's own portfolio of active loans. In 2025, managers closed over $12.9 billion in these loans, effectively layering dangerous debt on top of debt. This structure masks credit deterioration. Funds use NAV loans to inject emergency capital or pay out investors, delaying defaults until a broader wave of corporate failures triggers a cascade of margin calls. A potential trigger for this deterioration is the software sector. As enterprise clients shift their budgets toward AI-native solutions, legacy software-as-a-service companies are experiencing sudden revenue deceleration as their older subscription models are disrupting. Private credit has nearly 40% exposure to these technology and business services. For context, the retail loan default rate that caused significant market stress a few years ago was only 6.3%, a fraction of the concentration now held in software. In China, the risk takes a different form. Local government financing vehicles operate as off-balance sheet entities to fund municipal infrastructure, utilizing land use rights as their primary collateral. As property values plummeted, these vehicles faced a $1 trillion refinancing cliff every quarter. The situation forced a 10 trillion renminbi debt swap from the central government, migrating the shadow debt onto official balance sheets to prevent a systemic collapse. Whether the trigger is falling land values in the East or AI-driven revenue deceleration in the West, the extreme maturity mismatches in shadow banking create a recurring vulnerability where unregulated lenders must demand liquidity exactly when it is least available. There is a prevailing argument that moving risk from banks to sophisticated non-bank investors has made the financial system safer. However, analysis of the linkages between these sectors suggest otherwise. Banks and shadow banks are inextricably linked. In Europe, shadow banking entities hold approximately 1/3 of all outstanding euro area bank bonds, worth 1.5 trillion euros, making them a vital source of funding for the regulated banking core. The IMF's global stress tests indicate that if shadow banks face a liquidity crisis and draw down their credit lines, the capital ratios of 30% of European banks and 10% of US banks would suffer severe declines. Systemic risk was not excised from the global economy, it was repackaged. The regulated banking system is the ultimate underwriter for the unregulated shadow boom, meaning a crisis in the shadows will transmit directly to the core.